Why does Warren Buffett prefer buying individual stocks over mutual funds? Um, what happens is, if we apply the value formula where we take the net profit plus the dividend and divide it by the price to book, we get a ratio of value to price. And so using the value formula on food processing comes out with a score of 1.8. And this is a low score, which is below 2, which is mediocre. And food processing in general, buying that mutual fund, I would think that it possibly could fall. But if you take Kraft, a company that Warren Buffett owns, its net profit plus its dividend, notice it has a high dividend, but it has a much lower price to book on the average. You're paying less for the assets for Kraft than you are for a lot of other companies. Also, this net profit has fallen recently, so actually this was actually much lower when Warren bought it. It comes out to a 5.4, and when this was up around 1920, this was much higher, and the score was around 10. Warren was buying Kraft. When we look at the central banks and we do this, we come out with a score of 7.7. But Wells Fargo, that Warren recently purchased, at the time he purchased it, had a score of 18.9. Had a price to book where you're paying only 43% of its assets. Had a low dividend but a high net profit, and Warren was buying more of it. Looking at electric utilities, the net plus the dividend divided by the price to book comes out with a 9. But the NRG Energy that Warren recently purchased had a much larger net profit and a lower price to book, came out with a whopping score of 17.3. Scores that are over 10, Warren is interested in buying, and because he's getting a high return. He believes that the net profit will grow the company, and he's paying a low price to book, which he believes has some form of floor as to how far the stock can fall. This has been Alan Kendall. Have a nice day.